let's start with our second part of chapter 6, where we talk about the international parity relationships and forecasting exchange rate. Okay. So in terms of today's lecture, I'm going to first revise what we talked about last week. So last week we introduced the first international parity condition, which is the IRP, or interest rate parity. So this is my interest rate parity, right? It's slightly different in the tutorial, but I just rearranged the equation. It shouldn't be any different. So the IRP depicts the relationship between interest rates in two countries, for example, in the US and the UK, and the exchange rates, right, in the spot and the forward market. We can also write the approximation form, which is IS minus I pound approximation F minus S divided by X. Okay. So why is IRP important? So the IRP tells us, number one, the fair value of the exchange rates, and number two, whenever you have a change in the interest rates, you can use that to predict the movement in your exchange rate as well. Okay. So for example, if my US interest rate increases here, so whenever you see an increase in your US interest rate, you can expect to see an increase in the forward premium, right? So you can expect to see an increase in the forward, which means that you would expect to see the pound to appreciate in the future, okay, against the USD. So by looking at the relationship between the interest rates and the exchange rates, you can sort of predict where the exchange rate will go in the future, okay, based on the changes of the interest rate. All right, so we also talked about what happens when the IRP does not hold. So in the tutorial today and yesterday, we have gone through problem 3. And in that problem, we look at when there is a discrepancy, then people will arbitrage. And as people arbitrage away the mispricing, the IRP will go back to equilibrium, okay? So one more thing to note for the lecture last week was we talked about covered arbitrage and uncovered arbitrage, okay? So when you say covered, this is when you have a forward contract to lock in your exchange rate, so you're not exposed to any exchange rate risk. Whereas with uncovered arbitrage, you're looking at just the expectation about the future, okay? So in this case, you don't lock in your forward contract, and you will leave your position open until the future, okay? So if your expectation turns out to be correct, you will earn a profit. But if your expectation turns out to be incorrect, for uncovered arbitrage, you can also make a loss, okay? So that's the key difference between the two. So in the final part of the lecture from last week, we talked about empirical evidence of whether the IRP holds or not, okay? So over time, people have found that there is a certain bandwidth or a certain range within which the IRP seems to hold, okay? So the reason why the IRP does not hold very strictly in the real world is because we have different trading costs, okay? So for IRP to hold in a perfect, in an extreme form, you need a perfect market where you have no transaction costs, and it's very easy for people to buy and sell different financial products, okay? So because real life markets are not perfect, you've got transaction costs. So if you buy and sell forward or spot exchange rates, you're going to have to pay the bid and ask spread, right? Now, there are some cases where the country restricts capital flows. In this case, it's not easy for you to buy and sell foreign currencies, right? So in these cases, the IRP would not hold, okay? So that was last week. For this week, we continue with the second part of international parity conditions. And the focus of this week is firstly on the purchasing power parity. So when you see the word purchasing purchasing power, what do we think about? So purchasing power refers to prices, okay? So whenever you see purchasing power, this refers to prices, okay? We then also talk about the Fisher effects. So Fisher effects are the relationships between real interest rates, inflation rate, and nominal interest rate, okay? Finally, in the last part of the lecture, we will talk about forecasting exchange rates. So we look at how in real life people forecast exchange rates, okay? Okay. So purchasing power parity is a condition that is based on the law of one price. So under this condition, under the law of one price, it says that any product, any identical product should be traded at the same price in any market, right? So the price of, say, a McDonald's should be the same if I go to Bandura or if I go to Mulgrave, okay? So on and so forth, assuming no transaction costs, of course. So the law of one price holds because of arbitrage, okay? So the argument here is that if you have an identical good and it's traded at two different prices, then it gives rise to arbitrage profit. And as a result, people will arbitrage away the mispricing, okay? So as people arbitrage, they bring the prices in the two markets closer together, okay? So when we apply the law of one price for international trade, we will see that when we have two identical products traded in two different countries, the prices of these two products should be the same after we adjust for the currency differences, okay? So as a result, the prices that I pay for an identical product in, say, in the US should be the same as the price that I pay for that same product in the UK after I have taken into account the conversion of the currency, okay? So as a result, if I rearrange this equation from the law of one price, if I have my spot exchange rate on the left and everything else on the right, then according to the purchasing power parity, my exchange rate should be given by the ratio between the prices in two different countries, okay? So in this case, the spot exchange rate between the dollar and the pound is given by the ratio of the price in the US divided by the price in the UK, okay? So this is what we call an absolute PPP or absolute purchasing power parity because we are talking about price levels, okay? So whenever we talk about price levels, this is an absolute PPP. When we talk about price changes, then we talk about a relative PPP, okay? Okay, so as an example, now assuming that the law of one price holds, and what I have here is I've got two countries. I've got Thailand and I've got the US, okay? So a Coke in Thailand is sold for 50 bahts and it is sold for $1.25 in the US. So assuming that the purchasing power parity holds, then can we work out the spot exchange rate between the baht and the USD, okay? So here, assuming that the law of one price holds, that means 50 bahts will be equal to 1.25, okay? So one Coke in Thailand is worth 50 bahts and it's worth 1.25 in the US, and therefore these two should be equivalent, okay? So because they are equivalent, I can work out my exchange rate using this formula here. So I've got the baht over the USD. And it will be 50 bahts, which is the price in Thailand, divided by the price in the US, which is 1.25, okay? So given this formula, my exchange rate would be 40 bahts per USD. Okay. So once we have computed this rate, this is so we can call this the fair rate, a fair spot exchange rate as implied by the purchasing power parity. Okay. So once we've got this rate, we can compare this theoretical rate to the actual exchange rate in the market to see if the condition holds. Okay. To see if the PPP actually holds. So it's very rarely that we can compute the exchange rate for individual products traded between the two countries. So one way to simplify the problem is we can look at a basket of goods. Okay, so this is similar to the idea of computing the consumer price index, where you look at a basket of goods rather than just a single good. Okay, so in this case, the same idea applies. Now, my exchange rate between country A and B would be given by the price index or the price of a basket of goods between two different countries. Okay, so if I can construct an identical basket of goods in these two countries, then I can use the ratio of the price indexes between the two countries to work out my spot exchange rate. Okay. So for example, if I have an identical basket of goods that I traded at 1,000 yen in Japan and $10 in the US, then if I want to compute the exchange rate between the USD and the yen, I can take, so this is the yen per USD, okay? I'm gonna take the price index in Japan, and I'm going to divide that by the price index in America. Okay, so that will give me 100. Okay, so completely the same as before. The only difference is we use an index, so a basket of goods rather than just one single goods. So in the previous slides, we talked about the absolute PPP. In this slide, we are talking about relative PPP, okay? So when we say relative, we are looking at the change, right, of prices and the change of the exchange rate, okay? So here with relative PPP, the exchange rate movements should exactly offset any inflation differential between two countries, okay? So a change in my exchange rate should be explained by the differences between the changes in prices in two different countries. Okay, so here S is my spot exchange rate for the currency A over B. Pi is my inflation rate. Okay, so inflation rate is price in period T plus 1 minus price in period T in period T divided by price period T. Okay, so inflation is the change in the price level. So we say this is relative because we're talking about changes, not absolute value. Okay. Alternatively, we can also rearrange the equation so we can bring this to the right hand side, and that's exactly the same. Okay. Right. So this is the topic when I miss my projector a lot because I can't use it to show you guys how to derive these equations. What I had to do was I had to copy and paste a handwriting to my slide, okay, which is not too efficient. Okay, so from the relative PPP, I can also derive the approximation. So in this case, from my relative PPP, which is what we saw before. I'm sorry, this should be, yeah, I think I have, this should be pi, which is inflation rate. Give me 1 second, guys. I think I copied the wrong note. Just a second. All right, here we go. This is the correct one. I'm going to just delete this and I'm going to copy the right one here. Here we go. Okay. Here we go. Okay, so can we see the slide still? I have just copied the correct note in here. So what we have here is from the previous equation, right? So we've got ST plus 1 divided by ST. From there, we want to go to this equation, okay? So for this ratio, ST plus 1 divided by ST, I can rewrite it as ST plus 1 minus ST, right, divided by ST. So what I did was I just added ST and then I minus ST on the numerator, okay? So if I can write this equation, then this will become 1. And then what we are left with is the change in the spot rate, okay? So this is the change in the spot rate. So this ratio ST plus 1 divided by ST could be rewritten as 1 plus the change in the spot rate, okay? So here I call the change in the spot rate as the percentage appreciation of currency B, okay? So why is it currency B? That's because in this exchange rate, currency B is the commodity, okay? So here we're talking about the changes in the values of currency B, okay? So from the relative PPP, I can rewrite this equation as 1 plus the percentage change in currency B value or percentage appreciation in currency B times 1 plus inflation B equals to 1 plus the inflation in A, okay? So what I'm doing next is that I'm going to rearrange. I'm going to put, I'm going to minus both sides with 1. So I'm going to have this on the right hand side. So if I take this to the numerator, and I'll cancel these two out, I'll be left with this ratio here, okay? So given that the inflation rate is quite small, so 3%, so on and so forth, I can say that the denominator approximates 1, which means that the right-hand side would approximate inflation A minus inflation B, okay? So overall, I can say that the change in currency B's value or the percentage appreciation in currency B approximates the differences between inflation rates in the country, okay? So inflation A minus inflation B, okay? Okay, so in this case, if the inflation rate in country A is greater than inflation rate in country B, what do you think would happen to currency B? If A is greater than B, what would happen to currency B? Do we expect currency B to appreciate or do we expect currency B to depreciate? Yep, I've got an answer here. Currency B appreciates, right? Spot on, gang. Thank you so much. So when inflation A is greater than inflation B, then the right-hand side would be positive, right? So we would expect to see a positive number. That means we expect to see a positive change in the exchange rate, okay? In other words, we expect the value of currency B to appreciate in the future, okay, against currency B, currency A, okay, and vice versa, okay. So when the inflation rate in country A is lower than the inflation rate in country B, in this case, we expect currency B to depreciate, okay. Okay. So we have talked about relative PPP and inflation rates, okay? Inflation rates is the change in the price and it doesn't change real values, okay? But what happens if the PPE changes and there is no changes, there's no corresponding change in the exchange rate, okay? So whenever there is a change in the exchange rate, we expect to see a corresponding change in prices. If that does not happen, then we will see a real change in the exchange rate, okay? So by definition, any appreciation in the real exchange rate measures deviations from the PPE, okay? So changes in the spot rate does not reflect differences in inflation rates between the two currencies in question. So to see why is the case, I'm just going to my note here. All right, so in this note, I'm explaining the relationship between purchasing power parity and real exchange rates, okay? So we're gonna start with the purchasing power parity, which is here. So 1 plus E equals to 1 plus inflation in the domestic country divided by 1 plus the inflation in the foreign country, okay? So here E is simply just a change in the exchange rate, okay, which is what we talked about before. I just changed the notation slightly, okay? So E here is the change in the exchange rate, which is what we saw before, okay? So here I've got the inflation rate of the domestic country. It is country A in your previous slide. And on the denominator, I've got the inflation rate in the foreign country. It is similar to country B in your previous slide, okay? So I'm going to call the PPA equation 1. Now what I'm going to do next is that I'm going to rearrange the PPA. So I'm going to bring the left-hand side to the right-hand side so that I've got this bit over here, okay? So if I rearrange equation 1, I will get 1 equals to 1 plus inflation D divided by 1 plus inflation F times 1 plus the change in the exchange rate, okay? So I'm going to call the left-hand side Q for real exchange rate. So if the PPP holds, if relative PPP holds, then Q will be equals to 1, right? Does that make sense? Under the PPA, this whole ratio should be equal to 1, okay, from equation 1. Which means that whenever there is a change in the inflation rate, if it is met by a change in a exchange rate, then there is no change in your real exchange rate, okay? So if the nominal exchange rate always reflects the changes in nominal interest rates between two countries, then there will be no change in the real values of two currencies, okay? So in this case, the relative values of the two currencies stay the same. Okay, so what if the PPP does not hold? Okay, so when the PPP does not hold, when the changes in the prices are not met by changes in the relative exchange rates, then you will see a change in the actual real exchange rate. Okay, so whenever PPP does not hold, then you will see a change in your real exchange rate. So for example, if Q is less than 1, so if we go back to our previous equation, if Q is less than 1, then that means the change in the price level in the domestic country is smaller than the change in the price level of the foreign country, okay, after adjusting for exchange rate differential, okay. So here what we see is therefore a change in the actual prices in the two countries, okay. So if this is the case, if Q is less than 1, then the price in the domestic country is cheaper. That means the competitiveness in your domestic country increases, okay? So when prices are cheaper, it makes your goods and services more competitive, okay? Similarly, if Q is greater than 1, in this case, if you go back to rearrange your equation 2, sorry, you will find that the change in the price level in the domestic country is greater than the change in the price level in your foreign country, okay? So in this case, we have seen an increase in the real prices in the domestic country, okay? Which means that our competitiveness will decrease, okay? So when your prices are too expensive, you become less competitive in the international market, okay? So as a result, whenever you see a deviation from the PPP, that is when you have a real change in the exchange rate, okay? So from the example that we saw before, the real change in your exchange rate would be given by the differences, the differential between the actual exchange rate and the rate implied by the PPP, okay? So in terms of the relation between the PPP and the future spot exchange rate, so one way we can use the PPP is we can use it to estimate the future spot exchange rate, okay? So for example, suppose that the current spot rate is, for the Japanese and the USD exchange rate is 90 yen per USD. We also know that the inflation rate in the US is 5%, and we know that the inflation rate in Japan is 2%, okay? So using these numbers, we will be able to work out the expected value for the future spot exchange rate, okay? So in this case, the USD is my commodity and Japanese yen is my measurement currency, okay? So I'm gonna write ST plus 1 divided by ST equals to 1 plus I Japan divided by 1 plus inflation USD, okay? So as a result, if I want to find the value of the future spot exchange rate, I'm going to rearrange this equation. I'm going to put the the correct numbers into the correct places, and I'm going to find out the value of the spot exchange rate in the future, okay? So with the PPP, it gives you one more indication for to estimate exchange rates, okay? Okay, so what else do we use the PPP for? Now, so we mentioned before that the PPP gives us an indication of what is the fair value of an exchange rate, okay? So when we use the PPP, we can tell how much the fair value of the exchange rate is. So in this example, we are comparing the GDP that we calculate using the actual market exchange rates and the GDP that would have been if we have used the PPP, okay, exchange rate. So you can think of this as a fair value for the GDP, and this is the actual GDP, okay. So when we use the actual market exchange rate and the PPP exchange rate, sometimes we will see some discrepancies, okay. So for example, in the case of India, if we use the market exchange rate to calculate GDP, we will find that the market rate underestimates the GDP of India, okay? So the fair value is here, but if we use market rates, it would just be here, okay? Similarly for Russia and for Mexico, okay? So sometimes there will be discrepancies between the actual GDP you see and the GDP that would have been if you compute the GDP by purchasing power parity, okay? Okay, so how accurate or how realistic it is to expect the PPP to hold? So with the purchasing power parity, there are a few conditions, okay? So the first condition is that you need to have an identical good, okay? So the more generic the good is, the more likely it is that the PPP will hold, okay? In contrast, if you have a good that is very unique in different countries, then it's not likely you will see a PPA condition to hold, okay? So for example, we are looking at the prices for 4 different products across different cities in the world, okay? So in the first product, I'm looking at a hamburger. In the second product is aspirin. Thirdly, men's haircut. And finally, movie tickets, okay? So across this table, what we can do is we can compute the average, the standard deviation, as well as the coefficient of variation for each of the products, okay? The purpose of doing these exercises is to be able to compare the price differences between different cities, okay? So for example, when we talk about hamburger, we will see that most of the time the price of the hamburger is around 4.05, okay? So it doesn't change too much from one city to the next. The standard deviation is only 0.84 and the coefficient of variation is 0.21, okay? So this is the standardized difference, okay? Relative to hamburger, aspirin is a little bit more variable. So the coefficient of variation here is a little bit higher. And if you go through the list, you will see that in some countries it's very cheap and in some countries it's more expensive, okay? So one explanation here could be that in some countries there could be subsidies for medical supplies and in some other countries people pay full price, okay? Similarly, with men's haircut, you will see that the coefficient for variation is quite high. This is because you cannot simply import, say, a barber from Italy to Australia, right, to Melbourne, and so on and so forth. So the product here is not too generic, and as a result, you would expect some price variation here, okay? Similar for movie ticket as well. So this table illustrates that in some markets, in some products, when the product is more generic, then you will see the law of one price to hold a little bit more relative to other products, okay? So in terms of empirical evidence, as we have mentioned before, Sometimes the PPP does not hold strictly in the real world. Number one, because the goods are not too, the goods are very unique. And number two, there could be some frictions in the market, right? So if you have barriers to trade, for example, or if you have a lot of competition, say with the case of aspirin, you've got subsidies across different markets, okay? Also, if the goods are not tradable, then you can't really have PPP, okay? Having said that, the purchasing power parity still provides a good benchmark to compare exchange rates, okay? Okay, so we've got a relatively short lecture today. So why don't we take about 5 minutes break, and when we go back, we will go through the rest of the lecture, okay? So guys, we are going to take a 5 minutes break, and when we come back, we'll talk about the rest of the slides, okay? So I'll just be here. If you want to ask any questions, feel free to unmute your microphone or raise your hand, okay? Okay, guys, are we ready to go back? I'm going to put on my slides. Okay, so we have talked about the purchasing power parity, which is the relationship between price levels and exchange rates, okay? We are going to talk about the Fisher effect now. So the Fisher effect explains the relationship between nominal interest rates and real interest rate and inflation rate, okay? So accordingly, the nominal interest rate is equal to 1 plus the real interest rate plus, times 1 plus the inflation rate, okay? So if you rearrange the equation, you will find that the real interest rate, the nominal interest rate, is equal to the real interest rate plus the inflation rate plus a product between the real interest rate and the inflation rate, okay? So this terms is very small because this is a product between two very small numbers. So we can therefore approximate real interest rate as the sum of, nominal interest rate as the sum of real interest rate plus inflation rate, okay? So one thing to note is that this is forecast inflation rate, not past inflation, okay? So from the Fisher effect, if we combine the Fisher effect and the purchasing power parity, we will have what we call the international Fisher effect. So the spot exchange rate between the two countries should relate to the nominal interest rate in the two countries following this equation over here, okay? So from the purchasing power parity, sorry, 1 plus inflation divided by 1 plus inflation B. This is your PPP, right? This is your Fisher effect. All right. So given no changes in the real economy between the two countries, any change in your nominal interest rate should be driven by the change in the price levels, right? The change in the price level in your country. So if we assume there's no change in the real economy, we can substitute we can substitute 1 plus IA to the numerator of the PPP. Similarly, we can do the same thing for the denominator. If we do that, we will find that this equation over here, okay? So on the left-hand side, I've got my change in the spot exchange rate. On the right-hand side, I've got my nominal exchange rate, my nominal interest rates, okay? So once again, I'm going to approximate, I'm going to look at the approximate from of this equation. So if I take the two sides of the equation, I minus 1 of both sides, then I will get this form, okay? So we can rewrite this as 1 plus, sorry, we can rewrite this as the change in the exchange rate. It will be approximately the same as the change, as the difference between the nominal interest rate between country A and country B, okay? I've got my note here, okay? So from here, I'm going to minus 1 to both sides. Then I'm going to rearrange. So this will become the change in the exchange rates, and this is the difference between the nominal interest rates, okay? All right. So if we assume that the international Fisher effect holds and the IRP, which is the interest rate parity, holds, then the forward expectation parity should also hold, okay? So this is the international Fisher effect, which is what we talked about before, okay? So the change in your exchange rate should be similar to the difference between the nominal interest rates between country A and B. This is IRP, and we're looking at the approximate form, okay? So if we combine these two equations, so if we take this and we equate it to this, then we will get the forward expectation parity, okay? So what this says is that the forward premium or discount in your forward market should reflect the expectation about the future movement of the spot exchange rate, okay? 1 second. Thanks, Mom. Okay, so this is similar to what we talked about in the tutorial today. So we said that the forward rate is the conditional expectation of the future spot rate, okay? And this forward expectation parity reflects that sentiment, okay? So any change in the forward rate and the forward discount or premium will reflect the expected change in the exchange rates, okay? So this one is the expected change in the exchange rate. So to summarize the international parity conditions that we talked about today. So if we're looking at the relationships between nominal interest rate, expected future spot rate, forward rate, and inflation rate. So the relationship between these 4 different variables are explained by the relative parity conditions that we see here, okay? So for example, the relationship between interest rates and the forward exchange rate is given by the IRP, okay? So the interest rate parity condition, okay? So F divided by S is equal to 1 plus I A divided by 1 plus IB, okay? Similarly, for the international Fisher effect, it tells us the relationship between these 2 variables, okay? So this table summarizes the different international parity conditions and which variables they are talking about, okay? So for these parity conditions to hold, we need 2 things. Firstly, we need the law of one price to work, okay? So that means whenever there is any mispricing, whenever there is any disparity between the actual rate and the parity condition, then people should be able to arbitrage, and as they arbitrage away, these conditions are back to equilibrium. Okay. Also, for these conditions to hold strictly, we need to have a free market in the sense that we have zero transaction costs. We've got free trade, so people can trade currencies easily. Okay. Otherwise, if there's any if there's any restrictions on trade, then these conditions will not hold. Okay. So in terms of approximation, we can also write the parity conditions in the approximation, which is what we did before. Okay, so it's just the same as before. So in the next few slides, we'll talk about the different approaches that people use to forecast exchange rates. Okay, so when we think about forecasting exchange rates, we are talking about how people benchmark, the actual rates, how people form expectations about the future exchange rates. Okay, so here we will talk about the efficient market approach first, followed by the fundamental approach and the technical approach. Okay, finally we will look at the performance of the different forecast techniques. Okay, so with the efficient market approach, the idea here is that prices follow a random walk. So financial markets are efficient and prices reflect all available and relevant information. Okay, so at any point in time when you observe the market, the price is efficient in the sense that all information has already been reflected. Okay, so if this is the case, exchange rate will only change when new information arrives. Okay, in the absence of information, the exchange rate that you observe in the market at any given point in time is an efficient exchange rate. Okay, so if the exchange rate is very efficient, that means it will follow a random walk. A random walk is when it's very hard for you to predict the future movements because the future is not related to the past in any trends or anything. Okay, so if that's the case, if the future follows a random walk, then the best guess for your future is simply just what's happening today. Okay, so if I think the market is very efficient and if the exchange rate is 1.5 today, then the best guess for tomorrow is also 1.5. Okay, also if the exchange rate market is very efficient, then the forward rate reflects the conditional expectation for the future. Okay, given the information set that we have today. So if this is the case, then your best predictor for the future is your forward exchange rate. Okay, so according to this efficient market approach, it's very easy for you to predict the future. What you have to do is you just have to observe the future, the forward market for exchange rates. Okay, and that will be the best indicator for where the exchange rate is headed in the future. Okay, so according to this approach, the best predictor for the future is the forward market. Okay. All right, so the second approach is the fundamental approach. In this case, you don't really rely on the forward market, but what you want to do is you want to involve econometrics, and you want to develop a model that best explains exchange rates. Okay, so in this case, you rely on econometrics to tell you what best explains the relationship between exchange rates and the other macroeconomic conditions. Okay, so for the fundamental approach, you need three steps. First, you need to estimate a model. Second, you need to estimate the values for your inputs. And finally, you use the model to develop your forecast. Okay. So the downside of the fundamental approach is that empirically it has been shown that it does not do any better than the forward rate model. Okay. So for example, now in this example, I'm just giving you an idea of how a model could be constructed and how people use a model to predict future movement in spot exchange rates, okay? So for example, if you believe that the foreign exchange rate is best determined by three different fundamentals, so variable x1, x2, and x3, it could be, say, for example, interest rate, inflation rate, and what else is there? And GDP, right? So interest rate, inflation rate, and GDP, okay? So assuming that I think the best predictors for the exchange rate are these three variables, okay? So what I'm going to do is I'm going to try to estimate a model, a structural form for the relationship between the spot exchange rate and my three fundamentals, okay? So in this case, I believe that the spot exchange rate has a linear relationship with x1, x2, and x3 following equation 1, okay? So this is what I'm starting with. This is my structural form. So what I'm going to do next is that I'm going to have to estimate the parameters for the regression. So using historical data, I'm going to estimate the intercept and the coefficients for each of the variables in my model, okay? So once I have estimated the coefficients and the intercept, I have got a functional form to estimate the spot exchange rate, okay? So the next step for me is therefore to just estimate the inputs, which is x1, x2, and x3. So for example, if I want to estimate the spot exchange rate in the next year, I'm going to need the values for x1, x2, and x3 for the next year as well, okay? So the next step for me is therefore to predict the future values for x1, x2, and x3, okay? So once I've got x1, x2, and x3, I'm going to substitute back in equation 1, and I'm going to use that to estimate S, which is my future spot rate, okay? So that is the idea by using the fundamental approach to forecast exchange rates, okay? Now, I want you to think about the problems, the potential problems in using fundamental approach to estimate the future spot exchange rate, okay? So if I follow this approach to estimate the future exchange rate, what do you think is a potential problem or problems? So if we look at these steps here from an empirical point of view, there could be a few issues, right? So number one, how do I know that this is the correct relationship between S and x1, x2, x3, okay? So in this case, I'm assuming that S has a linear relationship with my variables of interest, with my independent variables, okay? Now, what happens if it has a quadratic relationship with x1, for example, okay? So if I get the structural form wrong, my estimation is likely wrong as well, okay? Number two, here I'm assuming that there are only three variables that could explain S, okay? What happens if there are more, okay? So when we omit important variables, it might bias the error term in our equation, and as a result, it will bias my estimation as well, okay? Now, the second problem that I can think of in terms of using the fundamental approach is that when I estimate the coefficients of this regression, I need to use historical data, right? So if I use historical data, it might be correct in the past, but it might not be correct in the future, okay? For example, the world economy looks very, very different 12 months ago relative to now, right? So using the historical data to predict the future might not be very accurate. Number 3, to estimate S, I need to first estimate the values for X1, X2, and X3, okay? So in some cases, it's easier to predict a future macroeconomic condition, but in some other cases, it's very hard to do so, okay? So for example, if you think about estimating the future cash rates, the future risk-free rate is quite relatively stable, so it's easy for you to forecast. But if you want to forecast something like as volatile as the GDP, it could be a bit harder to do, okay? So there could be some error term in this step as well. So the problem here, to sum up with the fundamental approach, is that your output is only as good as your input, okay? So if you have the model wrong, for example, or if you have your variables wrong, then your estimation is likely to be wrong as well, okay? All right, so the final estimation technique that we talk about is technical approach. So with technical approach, if you have done something like investment portfolio management or something like that, then we have talked about this in these subjects, okay? So technical analysis refers to a situation where you don't look at the long term, you don't look at fundamentals, you want to look at historical prices and you try to look for patterns, right, in the past. So here what you're going to assume is you're going to assume that the market is not efficient, and so the prices in the past might be able to inform you about the future, okay? So here your fundamental assumption is that there is a correlation between the past and the future, okay? Whereas for the efficient market hypothesis, you assume that there is no such correlation between the past and the future, okay? So as a result, the idea here is completely the opposite to the efficient market hypothesis, okay? So as an example of technical analysis, what we look at here is we are looking at the historical movements in your dollar to pound exchange rate, okay? So here I've got the dollar to pound exchange rate, and here I've got the timeline, okay? So what I've got here is I plot two different series. So on the blue line, I have the long-term average, okay? So here I've got the long-term market average. So it could be like a 5-year rolling average, right, of the exchange rates. On the black line, I've got the short-term market movement, okay? So this could be, say, the daily prices, the daily exchange rate that I observe in the market, okay? So the point here is that I'm going to analyze how the market moves. And here I'm going to assume that the market will revert to long-term trends over time, okay? So there is a long-term average, and every time when the market deviates from the long-term average, they will somehow go back eventually, okay? So here, if I compare the long-term average and the short-term average, or the short-term movement in the exchange rates, suppose we are here, okay? So here, what happens here is that the exchange moves like this, okay? So at some point in time, the exchange rate increases and it passes the long-term average, okay? So when the exchange rate passes the long-term average, what I'm gonna do, what do I want to do? So when the exchange rate passes the long-term average, I think that this is a good thing for me, right? Because I think that it's following a it's following an increasing trend. So as the market is moving up, if I'm standing here, I want to be buying the currency, okay? So if I think that the market is following an increasing trend, then I want to be buying the pound at this time, okay? In contrast, if I'm staying here, so in this case, the market is following a declining trend. Okay, so as my short-term average falls below the long-term average, I think that this indicates a declining trend. Okay, so as it's declining, I think that it's a good time for me to sell. Okay, so this illustrates how people use historical price movements to form their strategy, right? To form their forecasts for the future. So as you can see here, in our forecast, we are basing our forecast on a historical price. Okay, so as a result, implicitly we assume that the past information is informative for the future. Okay. All right. So we have talked about 3 different approaches to forecast exchange rates. So what we're going to do next is that we're going to look at a few methods to evaluate whether a certain forecasting technique is accurate or not. Okay. So as we mentioned before, comparing the 3 different approaches, the cheapest and the most available approach is just to use the forward contract. Okay. So in this case, because it's the most efficient approach, I'm going to use that as my benchmark. Okay, so I'm going to compare the performance of the other techniques to the forward rate. Okay, to the forward forecast. Okay, so to compare the performance of different forecasting techniques, we can compute this ratio here, which tells you the absolute error, the relative absolute error between your forecasting technique in question and the forward exchange rate. Okay, so here I'm going to use the forward exchange rate as the benchmark to evaluate the performance of a certain forecasting technique. Okay, for example, technical analysis. Okay, so on the top, I have the mean absolute error of the forecasting service. So I'm just computing the forecast number and the actual exchange rate, and that will give me the difference between the forecast and the actual exchange rate is the absolute error. Okay, I'm going to do the same thing for the forward rate as well. I'm going to compare the forward exchange rate and the actual spot exchange rate at that time. Okay, so the difference would also be my absolute error for the forecast, for the forward forecast. Okay, so this ratio here tells me the relative values between the absolute error of a certain forecasting technique and the forward technique. Okay, so what I want here is that if I want to argue that my forecasting technique outperforms the forward technique, then do I want to see a high number for R, or do I want to see a lower number for R? So in this case, if R is smaller than 1, that means my forecasting technique outperforms the forward rate. Okay, so when the absolute error for my forecasting technique is lower than the absolute error from the forward, then this ratio should be less than 1. Okay, so MAE S is less than MAE forward. So in this case, because I have a smaller error for my forecasting technique, I can claim that it outperforms the forward rate. Okay, and vice versa. If the ratio is greater than 1, that means my forecasting technique is not as accurate as the forward rate. Okay. Okay. So sometimes people also use the mean square errors. So the idea is similar as well. When you compute the forecasting ratio using the mean square error, the decision is the same. Okay, so you want to see a smaller R, which means that your forecasting technique has a smaller error relative to the forward exchange rate. Okay. So empirically, how well do the different forecasting techniques outperform the market? Okay. So empirically, what we find is that normally the more aggressive forecasting techniques don't always outperform the efficient market technique, okay, or the forward, right? So this evidence tells us that forecasting is quite difficult, and as a result, most of the time, the forward rate is the most efficient forecasting technique in the sense that it's cheaper to do, and also it's the error terms is not as the error term from the forward rate forecast is quite low relative to the other forecasting techniques. Okay. So if you want to look at the empirical evidence, one example here is from a study in Exhibit 6.13 in your textbook. Okay. So what this study did was that they look at different forecasting services from 9 major foreign currencies for a 3-month horizon. Okay. What I did next was that for each of the forecasting services, they compute the error rate. So they compute the rate between the error from a particular forecasting service, and they compare that with the error term from the forward forecast. Okay. So what they found was that only 24% of the time did the forecasting services outperform the forward exchange rate. Okay. That means for 76% of the time, the forward exchange rate actually outperforms the more aggressive forecasting services. Okay. So overall, it looks like these forecasting services underperform the forward rate. Okay. So as a result, this study concludes that forecasters don't necessarily do a better job than the market. Okay. So in other words, if you just use the forward rate to predict the future spot rate, it looks like a pretty accurate thing to do. Okay, rather than paying money to a professional to do the forecasting for you. So to summarize what we talked about in this topic, so in this topic, we have looked at the different relationships between exchange rates, either spot or forward, and other macroeconomic indicators, okay? So we look at prices, we look at interest rates, and we look at inflation prices as well, okay? So in terms of interest rates, we talked about the interest rate parity condition. With inflation or price index, that was the PPP, so purchasing power parity. In terms of real and nominal interest rates, we talk about the Fisher effect, okay? So these were the things that we discussed in this topic. We also look at different combinations of them, and a summary is, you could find a summary slide in one of the previous slides before. So the reason why we want to understand these parity conditions is that we want to use them to work out the implied value of the exchange rates, okay? We also want to use them to predict future exchange rates, okay? In the final part of the lecture, we look at different forecasting techniques. For example, we look at technical and fundamental approaches. We also talk about the efficient hypothesis, the efficient market hypothesis, in which case we assume that the market is very efficient and the best predictor for the future is the forward rate, okay? We also look at how to evaluate the performance of different forecasting techniques. So in the future, if you have to pay to use a forecasting technique, think about how is it compared to the forward rate, okay? So is the forecasting error doing better or is it the same as the forward rate, okay? So these were the main points for this topic. And as I mentioned before, we've got a relatively short lecture today. So for the purpose of the midterm, you will need to understand this topic for the midterm, okay? Any questions so far? Okay, so if there is no more questions, let me conclude the class for now. Yep, I've got a question here. Nope, that was a good topic. Thanks, Leah. All right, so let me conclude the topic for now. Thanks so much, guys, for joining in today, and I will see you next week, okay?